APY looks like one simple percent, but a lot of people read it wrong and leave money behind. Here's what you need to know. APY gets misunderstood because people treat it like a guaranteed interest payout, when it's really a yearly estimate based on rules. A bigger percent usually wins, but only if the balance and time match. Compounding can be small and low rates, but it still changes the math over a year. APY also assumes you leave the money in for a full 12 months, and fees can erase the benefit even if the APY stays the same. APY exists so you can compare accounts fairly, because it bakes in compounding while APR is the base rate before compounding. Compounding frequency matters. Interest added daily ends up slightly higher than interest added monthly, even with the same APR. Most banks calculate, or accrue, interest every day based on that day's balance, but they may only post it to your account monthly. That's why APY is the better apples-to-apples number when shopping. Here's the actual mechanics. APR is the raw rate, and APY is what you earn after compounding. The standard formula is APY x 1 plus APR n, 1, where n is the number of compounding periods per year. More periods means a higher APY, even if APR stays the same. With daily compounding, n is 365, and interest typically accrues daily, so the dollar impact on real balances is measurable over a year. Even with a strong API, your results come down to how the bank calculates your balance and how you move money. Many accounts use average daily balance, so timing matters. A deposit on the 1st earns far more than the same deposit on the 28th. Withdrawals reduce that day's balance, which cuts that day's interest immediately. Compounding adds a little lift, but a $10 monthly maintenance fee can overwhelm the gains. Always ask how interest credits and when it posts. To use APY correctly, you have to read the footnotes that define when you actually get that rate. Look for tiered rates, where the headline APY only applies above a certain balance, and confirm any promo end date. Check minimum balance rules and whether fees kick in if you dip below them. Also match compounding to crediting, because monthly posting can affect your timing. Then calculate your net yield, interest earned minus fees, on your typical balance. APY only describes a one-year outcome, and fees plus balance timing can turn a great rate into a weak result. BankingHub shows your best matches based on how you actually bank and calculates the real dollar impact for your balance. It's free, takes 2 minutes, and the link is in the description.